Welcome to the weekly update, where I'll go over the action in the market for the week of January 21st through the 24th, and then we'll see how things look for the week of January 27th through the 31st. Looking pretty positive right now. We are overbought on the daily charts on a short-term basis. We've been overbought for a few days, and we're also seeing some things that could suggest that we might chop sideways for a while. Now we hit an all-time high with the S&P on a closing basis on Thursday. We hit an intraday all-time high on Wednesday, and we're seeing volume below average on the weekly charts. And that's a little bit of a concern to hit an all-time high and see a decrease in volume. That's kind of a classical technical analysis divergence in a negative way. But things are looking pretty positive. We have the new administration in there, and all kinds of changes are taking place. Of course, there's a whole list of geopolitical things going on too. But as the market's trying to figure out, okay, what are these changes going to be? Are they positive? Are they negative? So far, they seem to be leaning more towards the positive side. Now, remember, there's stock market reality and then there's reality, and the two don't always line up with each other. So, on a personal level, you might really like some of the changes that you're seeing, or you might not like them, but the stock market may feel the opposite way. And a lot of buzz around AI right now with programs and things going on in that whole arena. And economically, it still looks like things are doing good. The market's a bit concerned about inflation. We're going to have the Fed meeting this week. There's been some comments between the new administration, specifically Trump and the Fed. He wants to bring interest rates down, and the Fed is an independent agency, and they're supposed to not be political and be free to do what they think is best. Not that it always works out that way, but that's the theory. So our charts are looking pretty positive right now. If we do chop sideways or even see some kind of a decline that's a little more negative, that would be expected and normal. But we're kind of looking pretty good right now. Okay, so before I get into this, I do post videos every day. So if you see something that you like in this video and you want updates, because I really hone in on the subtle little changes from day to day, please feel free to check out the daily videos that I post on YouTube and Rumble. I do have a PDF that you're welcome to download. It shows these charts. It shows the that I use in this video. It shows all the slides and text and everything. Some folks find that helpful. I do update pivot points every day on the YouTube community tab, both that apply for the whole month, and then I update it as each day goes by. And then there are pivot points that apply only to that particular day, and they can be really helpful as support or resistance levels. There's a private Facebook group. You're welcome to join that. And I do really go through and watch YouTube and Rumble comments. I don't get a lot of comments on my videos. The videos that I do, I'm not trying to really take a stand one way or the other. I'm just trying to let the evidence say, okay, we're looking positive, we're looking negative. Here's something good to look at. Here's something that could be a concern. And so instead of just saying, this is what's going to happen, I just kind of let the evidence speak for itself. And that doesn't produce a lot of feedback. I do get garbage comments from time to time, bots putting stuff up there, these social media experts that come through and want to tell me that they've got the answer to everything. Those comments get deleted because they're just garbage. But if you have a legitimate comment, I do provide an email address. You can contact me directly if you would like, or if you want to have a back and forth with a comment, you're more than welcome to post them. And I do post on Rumble. Here's the link. So let's go back. We were up 1.74% for the week, another up week, but we were below average with volume. And so we're a little bit concerned about that to see the market going up, to see us setting an all-time high intraday and then closing, and then to have volume dropping off. Just want to keep an eye on that. We are positive when we look at our charts, both on the daily side, and I'll try to compare the two as we go through the charts here. And we'll get another read on inflation coming up. We're going to get the initial reading for GDP. We're also going to get the core PCE later in the week. And of course, the Fed's going to come out and make some statements about that. Interest rates had been coming down, and that was helping stocks to go up. Now they're kind of chopping. They went down a little bit on Friday, but they're not going down that fast right now. We're kind of watching that 4.5% level with the 10-year yield. When we got above that, that's what started to pressure stocks. If we can drop below that, that might help stocks continue to go up. And of course, all the geopolitical things. There's still a war between Russia and Ukraine. There's still things going on in Israel. Um, of course, there's a lot of domestic issues that are going on in the U.S. with the fires in Southern California, Los Angeles, and of course, all the changes that are happening politically. And so there's a lot really to digest right now. But we just kind of take that and say, okay, how is the market reacting to those things? And then we will get a lot of Fed speak because there's some comments between Trump and the Fed. So we'll see if that is dealt with in the upcoming week. And as far as our trend, we are still positive. The green line's above the red line, but we're not trending right now because the ADX is below 20. And I'll show you on the chart and try to go through that a little bit. So I have a number of bullet points here, and I hope it's not too small. I try to put this all on one slide. Of course, you probably already know this. Trump was inaugurated on Monday. It also lined up with MLK Jr. Day. They just happened to land on the same day this year. The markets digested all these things that have been announced, like declaring a national energy emergency, and he's signed all kinds of executive orders. Now, this is not the way the U.S. government is supposed to work, but it's what it's evolved into. And this is not just Trump, it's not just Biden. This goes back decades where the president can do something. It's not law, but Congress is the one that needs to pass laws. But things get deadlocked there, and so presidents jump in and they make all these changes. And some of them are seen as good, some of them are seen as dangerous or reckless. The one takeaway so far with these executive orders is there's been really no mention of, okay, what about the tariffs on China? There have been announcements or plans to put tariffs on Canada and Mexico, and that indirectly deals with China because a lot of things come from China through Mexico or Canada. Um, and this is planned to start February 1st. We'll have to see. Now, if you know U.S. history very much, if you go back before about 1913, because that's when the Fed Act was enacted, that's how the U.S. made money was by tariffs. That's how the U.S. government had income from doing that. Then under Woodrow Wilson, things changed to, okay, now let's just for a short time and just for the really rich people, we're going to ask you or tell you to give us part of your income and we're going to make money that way. Well, didn't last. Usually those things start off by just the people who can do this and just for a short period of time. And then now it's evolved into it's a mandatory thing that everybody has to do with as far as income tax. And so it's not like this is brand new. This has been done before. Whether you agree or disagree, this is not something that's just flying in out of the blue as far as the tariffs. Let's see. The really hasn't been a mention of any really direct tariffs on China to right now. There was a $500 billion AI infrastructure initiative or bill to kind of promote that area. They're calling it Stargate. And the three big companies, OpenAI, SoftBank, and Oracle, those are the big companies that are involved. But this is benefiting the whole tech sector as well, because this is such a new area and it's Still trying to figure out, okay, which way are all these things actually going to move? And then Netflix came out with a really strong earnings report, and they had a real increase in subscribers. Procter and Gamble, Travelers, we're in earnings season right now, and most of the companies in the S&P are beating the expectations, and that can often give a good pop to the stock price. And then we did set an all-time high on an intraday basis on Thursday, and then a closing high on, excuse me, on Wednesday, and then a closing all-time high on Thursday. We pulled back a little bit in Friday's session. And then President Trump did use Zoom or Skype or whatever he does. He addressed the World Economic Forum. And some of the highlights were that he's really trying to press oil prices to go down. He's also saying, okay, other NATO countries, the U.S. is picking up most of the bill here. We need you to start paying at least 5% of your GDP into NATO to start paying for this too. And he worked on that during the first term that he had. Also said, okay, if you're a foreign company, if you come to the U.S. and build plants here and hire Americans, you're going to get some pretty nice breaks as far as taxes. If you don't, then we're going to put tariffs on you. So there's some incentive there. Remember, Trump is a businessman and he's a negotiator. And so he throws these wild things out there like, hey, let's get Greenland. Let's make Canada the 51st state. Take back the Panama Canal. And he's just throwing that stuff out there and then saying, okay, now the other side, they're caught more defensive and saying, well, we better counter back with, well, maybe you shouldn't change the name to the Gulf of America, just stuff like that. Okay. And he also added, now this is the part that, at least on paper, it's probably overstepping. He's going to demand that interest rates come down immediately. He is not supposed to control that, nor does Congress. It's the Fed that controls that. Now, you may agree or disagree about the Fed and the fact that they even exist, but that's how it's set up. And so this will be kind of interesting as it plays out this week because they're going to be asking Jerome Powell at his press conference, oh, how are you going to react to what Trump said? And they'll probably say we're an independent agency and we'll do what we think is best, and they'll be back and forth about that. And in the upcoming week, there's going to be some big earnings reports that come out. Apple, Microsoft, Meta, Amazon, Tesla. We're going to get the first reading of the fourth quarter GDP. We haven't seen that number before. It also has an inflation component in it. So that we get GDP reports all the time, but it's first the advanced, then it's the second look, then it's the third, and so but this is the first time we're getting the fourth quarter for 2024, and we're also going to get core PCE later on in the week. The Fed will be meeting. It's pretty much assured, I'll show you later. They're not going to change rates around this one. And the broader market did have a pretty good week. We're seeing value. We're seeing more stocks in the S&P. We're seeing the mid caps and the small caps are still lagging for right now. They're not falling apart, but they're not showing a lot of strength. But we're seeing other than just the Magnificent Seven stocks participating in the upward move. And as far as interest rates, we were up two ticks there. A week ago, we were at 4.61% with the 10-year yield, and we closed Friday at 4.63. They had been going down. It was dropping even below this 4.61 level, but we didn't quite get down to 4.5%. The dollar was down too, and the stock market likes a weaker dollar. So the fact that that declined has been helping stocks after it had been really strong. So for the week, the Dow was up 2.2%. Earnings reports coming out, not setting an all-time high with the Dow, but in Thursday session, it was the strongest index, but then it's just kind of been floundering for the most part lately. And the Nasdaq was up 1.7. We were up 1.7 with the S&P, and small caps were up 1.4%. But still, on the daily chart, and you'll see here on the 13 week, we're not getting above a moving average. It's acting as overhead resistance. Okay, here is a look at inflation, comparing it from 1966 to 1982. We're still potentially in this area where we're coming down with inflation. And I point this out every week just to be aware that things can change. And we're seeing a lot of change going on right now that'll eventually work its way into the economy. And also, what's that going to do to inflation and interest rates? Where in the mid to late 70s, we saw a massive increase in inflation. Is something like that going to happen this time? We don't know. We'll just keep an eye on it and tune into the videos and see if, how things are changing. And we're still above the 4.02% with the 10-year yield. We're at 4.63, so that's when it starts eating into corporate earnings at that point. No update here. We won't get this until we get the next employment report. And then we are still looking good going out as far as earnings. Week after week anyway, lately we've been seeing where all of these numbers are going up and to the right, and that justifies stock prices going up. And under second term presidents, which that's what's happening now, stocks do better early. This is the post-election year. And then it's like, okay, second term president, well, that fits right now. New president, well, that fits because there was a previous president. And then the average year. So again, you can take these numbers and depending on how you present them, you can come up with, yeah, things are looking good, things are looking bad, things are looking kind of indifferent right now. That's why I look at a lot of different seasonal charts and historical averages and things like that because you can get a wide variety of different conclusions on things. And then corporate insiders, this is a bit of a concern. These are people inside the company like CEOs and corporate officers and things like that. According to this Bloomberg chart, they're really selling a lot of shares. And that's not a vote of confidence. So we'll have to see if that changes. There's some other charts that we look at, usually on a weekly basis. I go over it in the video for Tuesday because I get that information over the weekend where we look at, okay, how is insider buying or selling behaving right now? Probability of a US recession in the next year continues to drop, anywhere from 20% down to about a 15% chance. Now, this could change and it could change quickly. And there are some things that we're looking at suggesting, okay, we might be going into a recession. The market's not anticipating that at this point. Now, the bond market, they're concerned about inflation, and that's why interest rates have been going back up. But there's not an awful lot of concern right now about in a recession itself, but that can change. So we keep an eye on things that way. And then the euro's been really bouncing back against the dollar. It had a really solid up week. And then dealing with earnings season, I go to factset.com to get this information. And it just asks the question, are the Magnificent Seven companies the top contributors to earnings growth? And the answer is yes. And you can see here, they're having earnings growth of 21.7%, which is really solid. When you compare it to the rest of the companies in the S&P, um, we're up 11.4%. That's any 8, 10%, that's considered good. And take it all together, it's 12.5%. So it's not as robust as it was before, but you can see here the comparison between the two. And then the chart over on the right-hand side, that's looking out into the future. And we're still seeing a lot of the growth coming from the Magnificent Seven stocks. And that's why you hear about these stocks. That's why the volume on these stocks is so great because the earnings, even looking out, are looking pretty positive. And then the update, only 16% of S&P 500 companies have reported earnings to this point. And of those, 80% are above their estimates. And now you have to be careful with those things because a lot of folks like to implement a earnings type of strategy, but you don't know. I mean, a company can come out with a really good earnings report and it tanks. There's this thing called buy the rumors, sell the news. If you're seeing a run up going into the earnings and then they come out with a great report and then the stock goes down, you don't really know what's going to happen at that point. Or there could be a surprise to the upside or the downside, and that can have an impact as well. All right, here's the intraday chart going back really to the previous Friday. That's when we saw things start to really improve. And then, of course, we had the 3-day weekend, and then we were up on Tuesday here, and we're seeing a lot of the gains coming from the gap. So we gapped up on Tuesday, we gapped up on Wednesday, but you can see there's minimal intraday action. And that's why the pivot points that you see on here, the R1, R2, S1, S2, they're not very far apart because it's calculated based on what happens in the trading day. It's not taking the gap into account here. But we did go up and we were pretty much flat, but then we saw some nice little action here on Thursday, and that's when we, especially this little bump right at the close, that's when we set the all-time closing high. We actually had a little bit of a higher open on Friday, but then drifted down. And then right at the end, we were able to repair some of that damage. So looking at the week, and this is just the 4 trading days since we were closed on Monday, where all of the indexes were up except for the mid caps and small caps. They're lagging now. They don't like this higher interest rate environment, and they're just not performing right now the way a lot of people had been expecting. And this is going back to the beginning of the year where all of the indexes now are positive, which could be good because we're going to be ending January and we have the Santa Claus rally, we have the January effect. That didn't play out in 2023 and into 2024, but the month of January was positive, and then that tends to bode well for the whole year. So we're going to be coming up to the end of January. If we can end positive, that might suggest that 2025, at least from a statistical and historical standpoint, may end up being positive. Sectors for the week, we had communication, which is a growth area. Healthcare has been bouncing back. It's just been getting hammered a lot lately. And tech ended up being up. And we're seeing weakness right now in consumer staples, which if you own some staples stocks, this really sucks for you. But as far as looking at the bigger picture, we like it when staples are not very strong because they are more defensive. Where in a more positive environment, we want growth stocks. And the fact that they're languishing right now is actually more positive for the market overall. Energy is still it ended up being the only sector that was down. And then I resort these again according to their scooter score. The higher the score, the better looking that particular sector. And then we have discretionary communication and financial. We want financials to do well also, and they are. And that's what's helping the market overall. Where we're seeing healthcare and staples, two more defensive areas, those are the weaker areas right now. And the different sectors, and again, I sort these a little bit different, and they only apply to the 4 trading days that we had, where we had communication, tech, and healthcare's bouncing back a little bit. The other sectors measured this way ended up being down for the last week. Year to date, we have staples performing the worst, which we kind of like that. Again, unless if you own either some staple sector type investments or stocks inside of that sector, you're probably not all that happy because that's toilet paper and toothpaste. But the industrials are coming back. Energy so far has been pretty good year to date because there's some concerns about inflation there. And so we're kind of split down the middle right now, going back to the beginning of 2025. Then we look at the relative rotation graph here, where we're seeing discretionary. That's really the strongest area. Now, this goes back over the last year, and it compares it with its performance to the SPY, which is the ETF for the S&P 500. Communication, that's a growth area. We have been seeing a little bit of weakness lately in the financials. Tech is showing some improvement here. It's blue and actually moving up. And then a lot of the other areas are just kind of languishing right now as we're trying to figure out, okay, what's going to happen with the economy? Where are the strong areas of the market? And this looks at it in a little different way where we're seeing communication and discretionary doing better right now. And that's what we want in financials. Those have been looking pretty good too. And then these red areas have been under pressure lately. And then the tech sector's looking much better as well, which is a good thing in a positive environment. Then this is the looks at the major indexes over the last year. We're finally starting to see the Nasdaq 100 and the S&P 100, which are the big stocks that make up the S&P. Those are starting to show some leadership now. But again, this is a little bit different than the conclusions that I reach in the daily videos and even later in the weekly video. This goes back over the whole last year and compares everything together. So this the attempt here is to give a bigger picture look by using this. And where the other sectors, red and going down, those are the ones that are showing some weakness. Where we're seeing the S&P 100 and Nasdaq 100 doing the best. We're seeing a real improvement with the S&P 500, where the other stocks are kind of languishing right now. And then as far as sentiment, the latest reading from Investors Intelligence, we're pretty much neutral, coming in at 1.48. We're not down below one, we're not above three right now. Now, with the market going up, and because there's a weak lag here with this, we're probably going to go back up since the market's been going up too. We're neutral as far as sentiment, but we have been improving by looking at the next chart. We were getting pretty low readings. We're going up now, and we tend to go with that while it's moving in that direction. It's when it gets to an extreme negative or extreme positive reading, that's when we look at using this as a contrarian indicator that folks are too happy when we get up here, folks are too sad when we're down here, and that's usually when we see a shift in the overall market. We're coming in just below 50 right now, so we're neutral with the number itself, but the context is that we've been going up lately. The active asset managers are showing an improvement here, but not giving an extreme reading, with the latest chart coming in at 86.08. That's positive, but not extreme positive. The VIX has been coming down. That's still giving us higher readings than what we were seeing earlier on when we were setting all-time highs with the S&P. The VIX was a lot lower, but we are coming down, and that's more positive for stocks. Also, this is also positive when we see the black line continue to go down. This shows that the tech sector is outperforming cash. Or if you remember back to 2022, cash was actually outperforming. So it's more positive when this is going down. The right X bear bull ratio, they really got bearish there for a while, and then the market went up, and now they're turning back and being more bullish with things. We did see an improvement with individual investors. They actually dropped below zero when things were looking more negative. Well, then we go up, and suddenly they're back to positive again. And so we're getting a positive reading that's not extreme right now. We're still below the moving average with the Ulcer Index. This is another fear gauge where we're coming down, but we're right on the moving average on the daily chart. This is showing that there's not a lot of fear when we look at the spread between risky and not as risky options. But look at this like the VIX, where a low reading, okay, everybody's positive. There's not a lot of fear, but you get to a certain point with a low reading and it means complacency. And then that's when you look at a contrarian type of view with this particular chart. And then this shows an inversion here of that same chart. When this is going up, that means there's just not a lot of fear in the market. This is something that I got, I think it was from Isabel Net. Um, this is showing that same thing, that there's not an awful lot of fear right now, which is positive, but could also show complacency. So we want to keep an eye on this. We look at the VIX and then a 3-month average of the VIX and do a ratio. It had been starting to go back up. Well, since we're going up with stocks, now this is starting to come down, but it's pretty choppy right now. We're still declining with our long-term equity put call ratio moving average, and that is positive. This tends to go down when the market is going up. And the latest reading from the Chicago National Financial Conditions, we're still under the black line. No concerns there. The latest reading from GDP now. Now we're going to get real GDP. This is a forecast and an estimate of what they think GDP will be. And sometimes it's quite a bit different than what the actual number is. But we're coming in at about 3%. If this was coming in negative, then that would mean that this chart is anticipating that we're going to go into a recession. The fact that we're positive means that there's really no fear about that. And this is that same thing, just looking at it in a different way, where they're actually thinking the GDP is going to be a little bit stronger. We'll see how it goes when we get that report. No update here. We came up to this red line, which is zero point 0.5, and now we're starting to come back down. This has usually been a really good indication of are we going to go into a recession? But for right now, the employment situation seems to be holding up quite strong. And this is also not really showing any fears of going into a recession. It hasn't been updated for a while. And this is a quarterly report, also coming down after it had been going up. Really no fears from this one. Inflation now, this will be updated in the upcoming week because we're gonna get PCE and core PCE on Friday. But this just adjusts every day. We're not seeing a real big move with the inflation concerns. And then it's pretty much assured that the Fed's going to leave rates the same, 97.9. I mean, that's pretty stinking convinced that we're going to be at 4.25 to 4.5, which is where we're at now, which means that the Fed will not be raising or lowering rates. And we've been locked into that. This is kind of a historical way of looking at this, where the blue is the current reading. Then we look at a day ago, a week ago, and then a month ago. And ever since the Fed had their last meeting and they said, we're probably going to pause cutting rates right now, that's the market has locked that in as what's going to happen. You still have a few holdouts over here that think they may end up cutting rates. Then we also look out to the March 19th meeting. It's getting more and more probable that the Fed will leave rates unchanged at that meeting as well. And this is the area that we're looking at here, where that's getting more and more. Now, this could change, and there's still time until we get to this meeting. But the market is getting more convinced that rates are going to be unchanged there. A look at the Fed balance sheet here still shows it's declining overall. And this is the year over year change in the Fed balance sheet as well. We want to keep an eye on this. A very low reading here. This is a way of measuring liquidity. If we get to a really low reading, that means the liquidity's been all used up. Liquidity is positive for the market. And so we had spiked up a little bit here, and then we started to come back down, but we're still getting a very low reading with this. Okay, looking at breadth, we're still positive. When we look at the advanced decline line based on price and volume, we went up this past week and we're above the moving average. We're also positive on the daily side. We're positive with the new highs, new lows on the daily side. We're positive here as well. We're seeing an expansion of the new highs and a contraction of the new lows. We're going up with the 4-week moving average and the 10-week moving average, and we're also positive on the daily side. We're positive on the daily side with the advanced decline ratio. We're also positive here on the weekly side. In our trend, we are dropping below 20. This means a non-trending environment, but we're positive since the green line is on top and it's going up and the red line is coming down. The Arun indicator is still positive. We're above zero when we look at the oscillator itself, and it's giving us a really positive reading there. It switched back to positive this past week on the daily charts. Nothing really being generated here. It's called a mass index, and this tries to measure when are we going to see a reversal. We're watching something on the daily side. We've seen the first and second part of a trigger be generated. We're waiting for the third. And when that third happens, this indicator suggests that there will be a reversal in whatever was happening to make the triggers even happen. But we're still waiting for that to play out, and we're not getting those signals here on the weekly chart. Here's a daily chart showing that we did close at the all-time high on Thursday. We were down a little bit on Friday. We have been, last few days have been below average with volume. Now it's going to be below average too. That gets a bit skewed because it was a 4-day trading week instead of a 5-day trading week. But the Thursday and Friday, because we set the closing high on Thursday and we had a decrease in volume. That's mainly what I'm picking up on here. These are the pivot points. We're above the pivot here. These last for the whole quarter. And so that just gives us a positive look. When we're above the pivot point, that's positive. Below it, that's negative. If we really continue to go up, which that would be quite a move from here, we'll be seeing if this provides some kind of resistance. This is a bit of a concern, though. We're coming up to the top end of the trend channel going back to 2009. We hit this back in early December, and that's when we started to come back down. Is that going to present some kind of an issue again this time? But we're still positive. We're above the 50-week moving average and really going up with the S&P. And we use the moving average crossovers here. We're back above the 13-week moving average, and everything is going up here. And I'm trying to add some annotations to the charts here. I have three smart money indicators. I only have the writing on the first one here, but this is positive. We're going up and we're above the moving average. So this is looking pretty good here. We came down a little bit, but we're still looking positive with the McClellan oscillator. We're showing an improvement. We're crossing back above zero with the summation index based on price and volume. That's positive. We're seeing an improvement with the bullish percent index. It's back above 50 and going up on the daily side and here on the weekly side. That's positive. A little bit of a concern here. We're starting to roll over with the Swenlin trading oscillator on the daily charts. Sometimes that gives us early warning. Sometimes it ends up not turning into anything. We're also seeing a little bit of a tick down here, but we're still positive since we're above zero. And we're positive on the daily chart too. It's just rolling over now. We look at more the direction of the line. As far as momentum, we're still more negative here right now, even though we're improving based on price and volume. And we're getting a really high reading with the PMOs that are rising. That's extreme. We're just starting to get extreme with the buy signals, which in one hand, that's positive. On the other hand, when we get above this line, that means we're getting rather extreme, but we could still go up from where we're at right now. And we're also looking better and turning and being more positive with the PMOs that are above zero. We're not getting an extreme reading with the percent B indicator measured by the Bollinger Bands. We did get one on the daily chart. It lasted a day or so. It was Thursday when we had the closing high, and then we came back down a little bit on Friday. So we're still looking a little more negative here when we look at the longer term momentum with the short, intermediate, and long term oscillators. Now we're positive across the board, though, on the daily charts. Still looking positive here with the chicken money flow. This is smart money indicator number two, and we're still looking good daily wise. We're still looking positive here. We are flattening out with the red line. We had been coming down, and that was causing us some concern. Now we saw the histogram go up, and if we continue to go up, the red line would go up as well. And then this is smart money indicator number three. This is going back up, so that's positive also. And we declined a little bit, but we're still above 50 with the money flow. The force index is positive, and the rate of change going back 1 week, we were up, but not as up as much as we saw in the previous week. And we're starting to bounce off of this red line now. When we go back looking at the rate of change over 50 weeks, that's positive. And we're above the midpoint and going up with the Stochk RSI. That's positive. The Williams percent R is giving us an extreme reading to the upside, and that could show longer term momentum. You can see when we're really going up here, this can stay up in this extreme area for quite a while. We're above the midpoint with the ultimate oscillator. We're above 50 and now advancing with the RSI. These are all positive right now. We're turning back up with the vortex. The green line's going up as the red line's going down. That's positive. And we're above the moving average here with our longer term special K chart. That's positive. The copy curve, though, is still negative. We're positive on the daily side, but we're still negative here. And we broke down below this 10-week moving average, but we were able to get that back, and now we're going up from that level. So this support level held up. We are switching back and looking more positive with the Heiken Ashi. We're positive now with the Kegi chart. We're positive with the Renko chart, and we're looking positive here with the three-line break. So these charts are just different ways of measuring the trend, and we're seeing all the charts showing us the same thing right now. Ease of movement, another way of looking at the trend. The top is called an equivolume chart, where it tries to take direction and volume together. the thicker the bar, the more volume. And then if it's green, that's positive. If it's red, that's negative. And then plotted on that is the ease of movement. And we're above zero and going up. So that's positive there. Now, a week ago, when I did this video, we were a little bit concerned because we were seeing red O's going down. Well, we bounced back up this week, and now we're seeing green X's going up, and we're actually breaking above these previous highs that were giving us some concern. They're calling this a bear trap. Well, that's because we were coming up to this level and coming down, going up to this level, coming down, going up, coming down. We've been able to break out a little bit to the upside, but it hasn't changed this signal yet. If we continue to go up from here, that will probably be something more positive. And X's are positive where O's are negative. We're kind of flat now with our long-term PPO momentum study, showing a little bit flat here after we had been bouncing up in the intermediate term and looking a little more positive with with the short term. We're positive with the Elder's Impulse system for the S&P. We still have another green bar. This is kind of a big deal. We were negative with the parabolic SAR with the dots on top. After this week's upward move, we now have a dot underneath, and we're seeing a positive chart on the daily side. So these are confirming each other now. And then in the broad market, these are updated every day. The only area that's negative are the intermediate term for the small caps right now. Everything else is positive. And then we're still negative across the board with bonds based on price on all time frames. The dollar's been under some pressure lately, so in the short term, it's looking more negative. This is just a look at the different indexes. We're setting an all-time high with the S&P. Still have a ways to go with the mid caps and the small caps. The Dow had a good week, but not back to its all-time high yet. And the Nasdaq, this is another thing. It would be nice if the Nasdaq and Nasdaq 100 fairly soon could also set all-time highs if we still stay positive with the overall environment. That's so far not confirmed. When you have the S&P setting an all-time high, it would be nice if the Nasdaq and Nasdaq 100 fairly soon were also setting all-time highs. But this is still looking positive here and the Nasdaq 100 because when we were going down, it was the Nasdaq and Nasdaq 100 that held up better. Now that we're going back up, it's the value areas of the S&P that have really helped it to go up. If the mega caps and the real growth stocks really kick back into gear, that would help the Nasdaq 100, which would also help the S&P, and it would show us more of a confirmation here of a new high. And a week ago, I was pointing this out because this is longer term. We were seeing a series of lower highs and lower lows. We kind of negated that now. And I try to point these things out, especially when we're looking more positive. I'm looking for negative things. And when we're going down, I'm looking for positive things just to see what's developing. And this had been a concern because this is not a real healthy chart pattern. But since we had an up week, we may be taking care of that. The mid caps are doing okay. They're above their 13-week moving average, but not back to an all-time high yet. And this is where the small caps are stalled out right now. That's a 13-week moving average here on the weekly chart. It's a 50-day moving average on the daily chart. And we need to get above this and then close above this to turn more positive. The NYSE looking pretty strong, but not back to an all-time high. This is a daily chart of the Wilshire, which did set an all-time high. That's a broad market measure. And the FANG index setting an all-time high here. These are the big stocks. So they're doing quite well now. All stocks back above its 13-week moving average and going up. This takes U.S. and international stocks together. ARC was up 4.5% this week. Still in a longer term uptrend, but it has been chopping sideways quite a bit lately. And we're keeping an eye on the financial sector. One of those areas is the KWB Bank Index, where it was up over 1%, looking solid with the RSI, trying to turn back up and turn positive with the momentum. Seasonality, going back just to 2021 now, this only goes back 5 years. We've been up 60% of the time over the last 5 years, including this year, with a return of 1%. And then looking at traditional Dow theory, which just looks at the Dow and the transports, not at an all-time high here. We're lagging a little bit with the transports. Utilities are also lagging now. They were really strong there for a lot of 2024. Then they really pulled back. They're showing some improvement right now. And then I add utilities to traditional Dow theory. That's what makes it a little bit different here. And we're seeing a bit of a surge now, longer term, with commodities, and that's producing some inflation concerns. Oil, we're watching that for geopolitical reasons and for growth reasons. And as I said earlier, Trump is trying to say and do some things that's going to have oil prices come down because that's inflationary. Copper is still in an uptrend here longer term. We're improving, but still negative on the daily chart there. The dollar it's still in an uptrend here, as measured the way I measure it here. This is a weekly chart, but it's really been coming down lately. And gold coming back, I guess this would be an all-time closing high here on the weekly chart. It had been chopping more or less sideways. And silver is lagging a bit here, coming back up to its 13-week moving average, but still positive. And I've been really watching this a lot lately. This is the total bond ETF. Now, I've been watching the daily chart, trying to get back up to its 200-day moving average. Well, here, this is a 50-week moving average, and we're trying to stay above this. Because if this goes up, that means interest rates are going down, and that would be more positive for the market. Stock to bond ratio, monthly chart, still looking positive for stocks. This is a daily chart of the yields where we were going up, and this is when stocks were going down. Then we started to drop with interest rates, and that's when stocks started to go back up. We're seeing a pretty strong correlation between interest rates and stocks right now. And we're also watching this. We look at this every week from an international perspective, and this is a weekly chart. We're keeping an eye on Japan, the red line, because if they raised interest rates at the Bank of Japan this past week, if these rates continue to go up, if you remember back to last summer when we got above 1%, this triggered the end of the world day that lasted a couple of days there when everything came crashing down and the VIX really went up high and there were screams for an emergency rate cut by the Fed. And then, of course, usually when things happen that way, that's all emotional. There's no logic going on there, and it usually passes pretty quickly. But if this red line continues to go up, that could create some problems because that may mean that folks in Japan are going to have to do some things like sell US bonds and sell US stocks, which could push interest rates up, which could end up pressuring stocks even more. So we're just keeping an eye on this. Some relative studies, I'm still going back to the beginning of 2024 here. I'll switch this over when we finish out January. Gold has still been performing well, stocks, and then oil, followed by the dollar, and bonds are still underwater based on price. Still looking good here with our ratios. The Nasdaq 100 to the S&P, got the S&P setting an all-time high. Not quite there yet with the Nasdaq 100, but this is still longer term positive. The S&P 100 is outperforming the rest of the S&P 500, and those are the bigger stocks. Growth of value is still looking really solid longer term. That's what we like in a positive environment. Gold has been going back up as the dollar's been going back down. And we're pretty much chopping sideways continually here when we compare gold to stocks. And there's really no advantage right now, unless you try to time that, which can be dangerous. And bonds continue to underperform stocks longer term. Low volatility stocks, if this was going up, we would be more concerned. If this ratio continues to go down, that's more positive. Since these low volatility stocks are more defensive, like in 2022, that's what folks were favoring, and we were going down with the S&P at that time. Energy is still underperforming tech longer term, and discretionary is outperforming staples, and that's more of a growth area, and that's more positive for the market. Small caps continue to underperform the tech sector. We're not seeing any real shift there. Longer term, no real changes here with the NYC breadth thrust. We did get a nice little high reading here with the swag NYC breadth thrust after getting a low reading, but we were not in that 10-day window. So this isn't officially a signal yet. But anytime we get a high reading here, that is positive in and of itself. Longer term, still looking good here with the weekly chart for the S&P. This is a further blow up here, and we're well above this longer term trend line. Still looking positive with the Zahorchak. It's on a full-on buy signal or buy mode right now. NASDAQ 100 weekly chart still above this long-term trend line. And we're starting to tick back up. When we look at the 50-day moving average of the new highs, new lows for the NYSE, we had been declining, although we stayed above zero. If this could start to move back up, but that would be even more positive. And then we do that same thing with the S&P 500, a 50-week moving average of the new highs, new lows, starting to turn back up, but never did drop below zero. Then we look at some ratios, the Qs, which is growth to small caps, IWM, still above this blue line, looking pretty solid there. The NASDAQ 100, which is growth, and then we do a ratio with the Dow, which is considered to be value, even though Nvidia is now in there, and there's growth stocks in there. But this ratio is holding up quite well. It's if we really drop, that's when we have a cause for concern. And just keeping an eye on the 3-month yield, not really acting all that strange right now. The cumulative new highs, new lows for the NASDAQ for the most part has been improving longer term. And then we look at seasonality. January, we tend to be up 58% of the time with a return of 1.1%. Then we look at November to April. That tends to be the strongest time of the year. And then we look at November to January, take a little bit longer approach here. That tends to be positive. And we're in the second half of January, and we've been performing quite well. At least we've got a week left or a trading week left. And then we look at the whole quarter, which tends to end up being flat most of the time. We'll see how things work out that way. Thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.